Welcome to the 2023 Market Outlook. My name is Sean McDermott. I'm the president of Summit Investment Advisors, and I'm joined here today with Russell Rogers, Brian Carlson, and Scott Caskey. Today, we will be talking about everything from the full economy to inflation, stocks, bonds. We'll talk about geopolitics as well as the world economy. So the full presentation along with the notes and slides can be found on our website. So if you want to check out www.summitinvest.com, and then under the resources tab, you'll find Outlook 2023, the full version. So feel free to visit our website and you can find this information there. I'm going to start off talking about the overall economy, and it's themed finding balance. And so there's some cute graphics here. I love this one on trying to stack 4 turtles. I don't know if that's really possible to stack 4 living creatures like this, but anything's possible with photoshopping. Now, the reason they kind of say finding balance is because there's a lot of different moving parts of our economy. And this chart kind of starts us off with on the left-hand side, it talks about the United States, Eurozone, advanced economies, emerging markets, and global markets. In the middle here is GDP growth percentage. And GDP is, by definition, that's our gross domestic product. And so the gross domestic product is the total of all market value of finished goods and services produced within a country's border. They're forecasting about 0.5% GDP growth for the United States this year. If you look across the world, Eurozone, they're saying, okay, negative GDP growth, advanced economies, 0.4%, emerging markets like China, 3.5%, overall global economy growing at 1.7%. Now, these numbers are lower than what we're accustomed to seeing. Generally, we'll see 3 to 4% GDP growth here in the United States and across Europe. But because of inflation and a slowing and a cooling of the economy, we're not expecting as strong of growth and expansion. This far right column is our CPI number. And CPI represents Consumer Price Index, and that's basically a measure of the average change over time in prices paid by urban consumers for a market of basket goods and services. So if you think about food, clothing, shelter, housing, those are some of the main components of the CPI index. You'll see here that for 2023, we're forecasting 3% inflation, which, is a lot lower than what we experienced in 2022, where inflation was getting around 10%, and even higher for some types of goods and services. So Eurozone, advanced economies, global economy, we're expecting inflation to come down for several different reasons. One of the main ones is that interest rates are a lot higher now this year than what they were last year. So the federal government has raised interest rates, which has cooled the housing market as well as consumer spending. This chart here is looking at our leading indicators, and our leading indicators are basically a basket of 10 different economic indicators, everything from consumer spending to exports, manufacturing index. So it's kind of a compilation of a lot of different indexes. And the chart here goes all the way back to 1958. And what I want you to do is kind of focus more on the right-hand side of the chart. This is 2022 going into 2023. And as you'll see, the line is trending downward. And a downward trend historically has meant that the economy could potentially or go into a recession or is already in a recession. So obviously a lot of the indexes are saying, okay, yeah, the economy is cooling, world economy is cooling, and we might be going into a recession. Now, is this a really bad thing for the stock and bond market? Well, not necessarily so, because over time recessions come and go. And what we find is that the stock market is forward thinking, and stock prices have already probably priced in a recession or a slowdown in our economy. So one of the bigger or a couple of the indicators that go into this, the LEI index, is the unemployment rate. And right now, it's unemployment is staying kind of, pretty stubbornly low, which is good. We I guess would rather have more people working than not working, but right now they're finding that there's roughly 2 openings for every unemployed individual. So I'm of the opinion, and what we're seeing early in 2023 so far, is there's a lot more news headline stories that are indicating the tech companies and larger corporations are starting to downsize and let employees go, offer early retirement packages. The construction industry is obviously slowing down. We're hearing more from people that are, home builders, electrical union, and so forth, that are on furlough or getting laid off, which leads into my next slide, which is the housing market slide. So obviously interest rates last year, the Federal Reserve raised interest rates quite a bit. And so mortgage rates right now on a 30-year mortgage are over 7%. If you want to buy a new vehicle, it used to be 0% financing or 1 or 2% interest you'd pay on the loan, but now interest rates are 6.5% to 7% on even car loans. So what's happening is it's cooling our housing market. So new home construction or new home starts, as well as existing home sales, are down about 50% from where they were a year ago. All that is good and bad, but it's good on the aspect that it's cooling the inflation rate down, hopefully reducing prices in many different areas. It's good in the aspect that with higher inflation for people that are on Social Security, they've gotten an 8.7% pay bump for 2023. It's also good in the aspect if you're a bondholder or have money in the bank, you're getting a higher interest rate on that money. The negative side of it is everything costs a lot more than what it did a year ago, and it seems like once prices are up there, they're very slow to come down. So with that said, I'm going to introduce to you Russell Rogers, and Russell is going to be talking about stocks and our outlook for stocks in 2023. Russell, why don't you take it away?
All right, thank you, Sean. So inflation and the Fed's response to it have been one of the main drivers of the stock market in 2022. So if stocks are going to go higher in 2023, a prompt end to the Fed's rate hiking campaign will likely be a key component. Now, the timing of the last rate hike of this cycle is uncertain, but our view is that the Fed will pause during the first quarter of 2023 amid an improving inflation outlook and loosening job market. Now, we just got jobs data from December, and 223 jobs were added. So we haven't really seen loosening on the job market yet. Should that occur, stocks would likely move higher, consistent with history. And stocks have tended to produce solid gains after hiking cycles end. So we're going to look at that on the next slide. So on this slide, we're seeing 3-month, 6-month, and 1-year periods following the end of rate hike cycles. Now, you don't see big returns in every case, 1974, 1981, 2000s. We have a different set of circumstances in those cases. But we think that we're poised to have some solid gains following the end of this rate cycle. Now, on average, it's 10% one year later. So on the next slide, we're going to look at another historical data point here. And that is that the stock market has historically had a good year following a down year in the stock market. Now, if we look at this chart, we're going back to 1953. And we've got 18 periods, and 15 out of the 18 were positive. Now, what did that give us on average? 15% return on average. So through many economic downturns, recessions, geopolitical crises over many decades, the stock market has always recovered. So being patient, staying the course, usually rewards those investors. On the next slide, we're going to take a look at earnings. So throughout the 2022 year, you can see these earnings estimates have been revised downward. And LPL's forecast for earnings per share on the S&P 500 is 220, as you can see with the dotted line there. Now, our base case for S&P 500 earnings at 220 is going to bring us to our target for the S&P 500 on the next slide. But actually, if we jump to the next slide, we'll take a look at our base case. So the stock market is looking forward, and it's pricing in at the end of 2023. We'll actually be looking at the earnings forecast for 2024. So in 2024, we've got 240 earnings per share. Now, when you multiply that by our PE ratio, we've got between 18 and 19. We multiply that by our 240 per share. That's where we're coming up with our target of 4,400 to 4,500. Now, I want to focus a little bit on this base case here. This is obviously the most likely outcome at 60% probability. We've also displayed bull case and bear case. Now, on the base case, as Sean outlined, probably some pretty low growth, maybe flat growth GDP, with the possibility of a mild recession. We would expect that interest rates and inflation would both gradually move lower. And again, that the Fed would pause that rate hike cycle sometime in early spring or the first quarter. So that's where we get our price target here of 4,400 to 4,500. So another thing, revenue is going to continue to get a boost from inflation. Many of the blue chip companies have demonstrated an ability to pass on higher prices due to their pricing power. But margins will likely compress further over the next several quarters before support from lower costs potentially arrives. So to give a little bit more context, the S&P 500 at the beginning of 2022 was at about 4,800 points. It's currently at about 3,900 points. And so when we're looking at this target, that represents about a 10% increase from where we are today. So with that, I'm going to hand it over to Brian Carlson, and he's going to talk about the bond outlook.
Great. Thanks, Russell. Appreciate it. Good update there. So I'll talk about fixed income and bonds. And the theme is difficult year in 2022. And the question is, where do we go from here? But I do think stepping back just to look at 2022, one thing that doesn't get mentioned as much, and a theme you're going to hear, is the Federal Reserve, right? Russell touched on it, Sean mentioned it, and Federal Reserve has a direct impact on bonds and the fixed income market as well. What we saw in 2022 was actually the fastest pace of the Federal Reserve increasing interest rates that we've ever had in history. So typically, as interest rates increase, the value of a bond will lose its price value, right? So that's why we saw fixed income or the bond market struggle in 2022, but it was the fastest increase we've ever seen in the Federal Reserve increasing rates. So I think that's why it wasn't such a difficult year. Now, those bonds have reset, right? They've adjusted. The yields have now basically caught up to where the Federal Reserve has interest rates set now. And so our analysts do think, they're very positive on the next 12 to 24 months. We see a pretty significant value and a great risk reward opportunity within the fixed income or bond market. Now, it was a little painful to get here, but we're all where we are. And the point is, where do we go from here? And we do see some pretty significant value and opportunity in the bond market in general. So if we can go to that first slide, what we did is put together a slide of the 10-year treasury yield, which is, very sensitive to interest rate moves with the Fed moving interest rates. And so we put together a slide that basically is similar to what Russell went over, which is a base case or our most likely scenario, which is that middle column there, and what would drive that outcome. And then we also put together a bull scenario and a bear scenario. But yeah, again, let's focus on what our base case or our most likely scenario is, that mild recession, flattish growth, where, again, in keeping with the theme, maybe we hit a mild recession, but economic growth is slow, but still positive. Inflation, is already falling. We're seeing that both in the producer prices. Sean talked about consumer prices, but we also watch producer prices, which is the business input costs, basically, that get passed on to consumers. And we see those trending down as well. So we do think inflation moderates, hence that base case there in the middle. Now, the Fed, again, there's a phrase, don't fight the Fed. And I think that's true both in the equity and in the bond markets. They were very aggressive, as I mentioned, and they're likely to keep rates elevated where it's called restrictive, right? Where they want to try and slow down economic activity. So they may flex their muscle a little bit more here in the first quarter and go up to 5% likely from where they're currently at 4.5%. But we do think by the summer, if they will be largely successful, inflation will start to moderate. Economic growth, is going to start to stagnate, and they may end the year closer to where we are right now at 4.5% scenario. So that's our base case. The stagflationary environment to the right there, that's the bear case for bonds and fixed income. That would be inflation still ramps up quickly. They have to increase rates more aggressively. We think that's unlikely. The bull case, again, is not unlikely. That's the far left column, which is the hard landing scenario, which would be a pretty deep recession where the Fed would have to cut pretty aggressively and inflation declining at the same time. Again, we don't expect that as our likely scenario. We see mild recession and slow but positive economic growth. So if we could go to the next slide, what we did is put together in those scenarios, what's the likely return environment for fixed income. And you'll see the blue shaded column there. That's basically kind of the base case that I just talked about. We're at about 4.5% on the Fed Reserve rate. That would likely not change, the 10-year yield dramatically from where it sits currently. It's about 3.5, I believe, today. And so that should, in that environment, we should see very solid, positive, mid-single digit returns in the bond market. And remember, bonds are not, equities, right? We can't expect a high double-digit returns in a recovery year, but we do think we can definitely get some solid positive returns. And in an environment where the summer, shows some inflation slowing down, and the Fed, where they may start to be more accommodative, as they call it, or maybe you'll hear it talked about as a pivot in the news. If they were to cut rates by 0.5%, which is the column to the left of the no change there, that would be even bigger tailwind for the fixed income markets. Just as when they raise rate, it's a negative effect on prices. As they cut rates, that can be a tailwind or a positive for overall markets. So basically the question is, well, how do we recover from where we're at? I think the theme is, stay invested, especially in these fixed income instruments. We do see a positive outlook. And remember that bonds are not only an investment that we make as investors, right? But they're a financial obligation of companies. Basically, it's a loan from a company or a business to us as investors. We make the loan to the company, and they're paying us interest along the way, right? For the benefit of us giving them the money, and they have to pay us back full principal at maturity, right? So that's where I think our analysts see a lot of the value is we just don't see defaults being nearly as low, especially in a mild recession environment. And so bond investors are likely to get paid back that full principal along with the interest along the way. And so that's why we think, we may be setting up for a better environment. If we could just, although that is a very good question, as Sean mentioned, if we could go to the next slide, think about it in the mortgage rate environment, right? We've seen mortgage activity really slow down for consumers, you and I out there, right? Nobody really wants to refinance as your mortgage rates have creeped up, darn near close to 7%, over 6.5%. That really slows that activity. Well, the same idea works as far as with corporate or business debt. They use, bonds as a financial instrument, as a way to build their business and grow their business. It's a positive thing. But what can be a negative is if there's a lot of debt that's maturing from the business perspective, the corporate side of things that's rolling over, that they need to all of a sudden renew at what are now higher interest rates, that can be problematic. And so what we did is we looked at and said, okay, well, how much debt out there is actually rolling over here in the next few years? And you can see 2023 is that first bar there. It's very low. And corporations and businesses have done an excellent job over the past multiple years where we've had such a low interest rate environment. They've been able to retool their balance sheet, refinance debt at very low interest rates. So a positive here is that we, over the next couple of years before 2025, actually less than 10% of the outstanding corporate debt needs to be rolled over or refinanced, where they would roll into these higher interest rates. And so that's a very positive thing because they don't have to refinance into higher rates. That helps their balance sheet. And we do think post 2025 into 2026, we're going to have a better inflation environment, i.e. lower interest rates and a better refinancing environment for those businesses as well. So all in all, painful to get here, but we do see, moving forward, a very, positive potential outcome over the next 12 to 24 months in the fixed income market. So with that, I'm going to go ahead and hand it over to Scott Caskey. He's going to talk about our geopolitical outlook.
Thank you very much, Brian. So geopolitics absolutely was a huge component of our 2022 calendar year, the invasion of Ukraine by Russia. We learned a lot of things. We learned that Ukraine's the breadbasket of Europe. We learned that they are a major exporter of a lot of commodities. And currently that war still rages on, the largest land war in Europe since World War II. But I think the big take home here is, markets historically have navigated regional conflicts fairly well, despite that heavy human toll. And ultimately, this specific crisis led to a lot of inflation, right? And I kind of want to talk through, how that may look moving forward and talk more about maybe that structural commodity outlook. Right. And I have one good chart to walk through with you on that. That'd be the commodities index versus China's GDP growth rate. OK, now looking at this chart, China has a lot to do with the growth of commodities. Why? Well, they're the second largest country in the world and a major consumer of the world's commodities, right? So if we look at our chart here, on the left-hand line, we have the dark blue Bloomberg Commodity Index, right? And this is tracking it all the way back to 2001, right? That commodity index is weighted 30% energy, 20-some% grains, 15% industrial metals such as copper, aluminum. We have precious metals, that'd be your gold and silver, softs such as sugar and coffee. It's a really, really broad index, right? And it's a pretty good gauge of where we are. And looking at that commodity index past 2001, you can see that, we're kind of in line with the middle there, average or so, right? Of course, we're coming off a pretty significant low from 2020, and our prices have gone up for commodities, right? We paid a lot more for our energy prices with natural gas and oil, and we're all noticing costs of things when we get to the grocery store, right? Eggs are more expensive, bread's more expensive, pretty much everything. Right. And on this right-hand side here, we have China's GDP, constant price cumulative growth year over year. And you'll see with this index, right, that we see a significant rise of the commodity index in line with the increasing growth rate of China's GDP, and then typically a corresponding decline. Right. And you've seen that commodities have actually peaked at some point last year and have been coming down quite significantly, while at the same time, we're seeing China's economy contract. Right. China's been a major contributor to the world's economy, and they've had a boom in real estate projects. Right. They had a hyper growth rate, a very fast growing economy in the early 2000s, which significantly used the world's commodities. Right. We think about those industrial metals, copper, aluminum, things that are used to build. China consumes nearly half of the world's supply. right? And structurally, the outlook for China, their real estate projects have slowed dramatically. Developers have too much debt. And what we're seeing now is likely a slower growth outlook for China. And this is maybe a little less of that just what happened last year due to the specific crisis in Ukraine, right? This is more structural. And if we see China grow slower overall, that may be good news for us on that commodity outlook. And I think one other thing to think about too is, we've had decreased yields for some of our major commodities, right? Our corn, our soybeans, and wheat. And maybe the largest snow, we had a top 20 snow here a week or two ago, and the largest snow we've had since 2018. Maybe we'll finally see a turn of the tide and see a little bit of an easing up of this drought weather we've had for these last few years, which would be a big improvement overall for corn and soybeans. Okay, so hopefully that structural outlook will improve for us, right? Past the geopolitics, we have policy. And I want to review a couple charts here, and I think generally just want to point out that in the type of calendar year we're in, right, the market typically does well, and that's the year following a midterm. We have the historical information here, 1950 to today. The average gain is about 14.7%, regardless of Democrat or Republican, quite similar during that time frame, slightly better Republican, 14.8 versus 14.5 for Democrats. But historically, this is a pretty good year for the stock market, right? We have those major midterm elections, which are typically a pretty big headwind to markets, such as they ended up being for 2022. But hopefully we'll see here in 2023 a smoother road on the politics front now that those midterms are behind us. To add a little bit to this, our next chart, we do have a split Congress, and that's actually historically even been a little bit better, right? And you'll see that a split Congress typically yields about a 15.9% overall with a Democratic president, right? And that's the situation we're in here for the 2023 calendar year. So a lot of that political volatility likely is behind us. And, historically, when it comes to the policy front from politics in general, this is historically been a pretty good year. And we're certainly hoping so for 2023 as well. So I just want to thank you all for your attention and joining us here today for our 2023 market outlook. I do think we are, generally cautiously optimistic. We need to see improvement on inflation and on the many different things we've covered so far this year, and we'll be sure to keep you updated throughout the year as well. And with that, I wish you guys the best for the 2023 year.